This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now is someone that makes you lean forward. It is multi-asset strategy, but mostly he is Senior Vice President, courage to stay in the market at the Hong Kong and Shanghai Banking Corporation. Max Kettner darkens the London door today. What is your new outlook? What is the nuance of the last few weeks as you look forward into 2024?
You know, I think some of the nuances you guys were talking about already, right, is oil prices, energy prices. Perhaps that changes a little bit of the narrative, right? That perhaps inflation does pick up a bit more in the US, right, towards Q4. So that's not particularly great news for a Goldilocks scenario. I think the nuances is also going into Q4. What can destroy that Goldilocks picture, right? Because we're all talking about all these horrible things, right? Like, you know, things like student loan repayments and are we hitting recession and all these things, and then we look at high yield spreads and they're just going towards 350 and happy days for everyone, right? Great. So I think the nuances are sort of trying to find out what could potentially break all this, right? What could potentially break that sort of Goldilocks scenario.
Is $95 crude it?
No.
You don't think that could break this?
I don't think so. It's one nuance. I think it's one of those where, to be fair, if I was the Fed, if I was the ECB or the Bank of England, which, you know, lucky for everyone that I'm not, but, you know, if I were, I'd be basically saying, well, what should I do about that, right? What can I do about it? I mean, I'm not an oil producer, so I can't really do anything, and I can sort of use it as saying, look, this is just energy prices. It's something transitory. It'll be going away out of the calculation within a couple of months. Don't worry, right? All the other rest, you know, excluding 15 components from our preferred inflation baskets, then everything looks fine. So I think that's the worry that I have, right? That if we start looking at these inflation baskets that sort of exclude everything that we need for the everyday life, that they are starting to pick up again. And to be fair, if you look at things like super core inflation, right, the action components, the broad-based nature of it hasn't really dramatically changed over the last 12, 18 months. So that is perhaps something towards Q4 where perhaps inflation does pick up beyond just energy prices. Not a new inflation wave, but basically an interruption from that, okay, inflation has gone down in one straight line now, to actually now we're getting sort of this bumpy road ahead, right, in inflation, where we've got to play those turning points in it.
Max, the question everyone wants us to ask, are we still in a window where you think equities can do well?
Oh yeah, 100%.
Until
100%.
when? How big is that window?
100%. Look, to be perfectly honest, if we think about it, and I know it sounds stupid, but imagine if yields go up. Imagine the 10-year goes to 4.5. What's the reality? The reality is it's probably going to do it because growth is better, right? And because, once again, growth expectations actually turn out to be too pessimistic, right? If you look at Q4 US growth expectations, it's sort of zero. Q1 next year is also close to zero. So the bar to beat is relatively low. So if you get yields moving higher, that's probably in response to growth doing better, so you buy equities. If yields go down, right, then probably rates vol goes down, and then you buy the Nasdaq. So to be fair, yeah, great, I'll just buy equities.
Can big tech still lead, though? And we've seen a recent kind of weakening in the tech profile and an underperformance there. Some people are saying this is the beginning of the end of the tech trade. Are you on that train?
Well, we've heard that for, I think, 15 years. So, you know, it's been a lot of beginnings of the end. Now, look, I don't want to be too cynical, right? But
last year was pretty brutal for the tech trade. Let's be clear.
So, but to be perfectly honest, I think tech still has a bit of room to go in the next couple of weeks. There is probably a window around Q4 where I'd be moving more towards really the value side of things, right? Tactically, right? If we get that bump in inflation, particularly in the US a bit higher, you know, you want to probably prefer then for a couple of months things like banks or energy over tech. But for now, I think energy still has, or tech still has a way to go.
You mentioned all of the dark clouds, including people repaying their debts, and also this question around a government shutdown, which seems like an increasing inevitability in the U.S. Amid this backdrop of strikes and a question of just general just dissatisfaction, Which of those kinds of things do you care most about? Could actually have the most impact on your call?
Look, I think the government shutdown, not really, right? Because we kind of got used to it every other quarter. So from an equity perspective, I know it sounds depressing, but if we're honest, right, it was a shock 12 years ago. It's not particularly a shock anymore, right? So from an equity perspective, from a risk asset perspective, that's not the main worry. The student loan repayments also not particularly worried about it, because you can also make a positive spin out of it, right? You can also say, look, actually, from the end of July up until now, repayments have shot higher because actually economic agents, i.e. normal people like us, they're acting completely rationally, right? They're seeing that, okay, this is starting to kick in. So instead of starting to, or having to start to actually pay interest on it again, I'm going to repay it early. And guess what? I have the money, so let me repay as much as I can. So actually, you can also make a positive spin out of it, right? And say, look, people apparently still have the money to do that, right? They still have sufficient money to do these pretty chunky repayments early. So all of that doesn't really keep me that much.
A quick question here. Can you frame out SPX 5,000? I got to make some news today. I got to justify the trip to London. Can you give me 5,000 SPX?
I think, if we think about next year, to be fair, it's not an awful lot away, right? It's 10-12% away, right? And if we're thinking, if we're still in a fairly high-ish inflation environment, right, and earnings growth is still relatively fine, why not?
Noel Quinn's all under today. He's doing something with the United Nations. I'm not sure what it is. Noel Quinn listens to Max Kettner. HSBC is a prism to Asia like no one else. I personally witnessed it across that little Hong Kong trolley in Asia. How do you link China trauma, and particularly domestic trauma, into all the toxic brew of gloom in the West? How do you link Hong Kong and Shanghai over to London and New York?
Look, I think what's very clear with regard to Europe and with regard to China, and now a little bit less in the US, is, like you've said, there's all this doom and gloom, right? There's all these expectations around doom and gloom. I don't think you guys have had any guests on probably for weeks who are saying, look, you know what? 2023 has been better than expected. We were a bit wrong, right, on Europe and on the US, but guess what? 2024 is going to be even better, right? So I just genuinely cannot see how we're going to start to think about 2024, how we're actually going to see 2024 outlooks where people say, look, you know what? China's going to do great, Europe's going to do even better, and US is going to shoot the lights out. I just cannot see anyone doing that.
So do you want to take the other side of that?
I want to take that side, yeah.
Really?
Because the thing is, right?
So you're giving us a 24 call right now.
No, look, the one thing that I am not asked at all about, and for months, is what could actually go right.
What can go right next year?
What can actually, in the next 6-12 months?
3 months.
What's actually one thing where we could be saying, hey, you know what? Maybe
I'm asking
things
you, Max,
are not going to fall.
Let's go.
So what is the answer?
So the answer to me is, as long as we still have these really low growth expectations, you have a low bar to beat, and you keep rolling Goldilocks and Goldilocks and Goldilocks, right? It's great.
Goldilocks forever into 24.
Yeah.
Okay.
I think it is a lonely call. I mean, we're
It's incredibly lonely.
But it's a really...
I'm not saying it's the wrong call. It's not for me to say it's the wrong call, but
line
yeah,
them
it's
up.
lonely.
Binky Chad at Deutsche Bank, Max Kettner at HSBC. There's a couple others out there,
Max has been right. I think we should put that out there first. You've been right all year, Max. We'll see about 2024. That's quite a call. Max Kettner there of HSBC. Joining us now is Ed Yardeni, President of Yardeni Research. Ed, wonderful to have you with us on the show. We caught up with Max Kettner of HSBC in the previous hour, Ed, and he said we need to focus on what could go right in 2024. Are you more focused on what could go right or what could go wrong?
My view of 2024 is that could be a better year than certainly 2022 was, or even 2023. Not that 2023 is turning out to be a very bad year. As we know, the third quarter is turning out to be remarkably strong. So all in all, I think that we'll get through a lot of these challenges, and 2024 should be a better year for earnings, with the market doing better too.
Ed Yardeni, you and Ralph Enkapour have been way out front of this on the October rally, and we've talked about a second leg of a bull market. As John mentions, Mr. Kettner of HSBC shares your enthusiasm. The arch pullback of this is the great moderation over. Is the great moderation over, and does that mean you can't make money in stocks?
Well, I've been really debating in my commentaries about whether it's going to be the great inflation of the 1970s, or it might very well turn out to be the roaring 2020s. And I've been inclined to believe that on a longer term basis, we will see that the 2020s will be a period of tremendous progress and productivity. And I was making that point before the pandemic, and the pandemic sort of got in the way because it really messed up the productivity story big time as people quit left and right. But I think we're making a comeback. I think productivity bottomed actually in 2015. In terms of its growth rate, it was only 0.5% on a 20-quarter trailing basis. I think it's going up to 4% by the end of the decade, which sounds delusional, sounds far-fetched, I'll admit. But those are the kind of peaks we've had in previous growth cycles in productivity, and I think that's where we're heading.
Right. Does a real rate, and some would say a higher real rate, an inflation-adjusted rate, does that impinge on your enthusiasm?
Not really. I think we're going back to normal. The new abnormal was the period between the great financial crisis and the great virus crisis. And back then, interest rates were at record lows. I think we're going back to the environment just prior to the great financial crisis, where the TIPS yield was around 2% for the 10-year, and the inflation premium was around 2.5%. So 4.5% is kind of where the bond yield should be in a return to the old normal, and I think that's what we're doing. I think the economy and the stock market have already demonstrated that they can both live with these kind of levels of interest rates.
So you and Max Kettner seem to be on the same page, and Max came on the show earlier and said, you guys all worry too much. No one asks me what can go right, how good things can be, and that's what they should be asking. But it is my job to worry. That is sort of what I do. So I'm curious, from your vantage point, where does oil fit into this at a time where it's risen 30% since June?
Yeah, well, I didn't expect it. I don't think anybody really expected it. I think the widespread perception was, the Saudis are going to cut production and the Russians will cut production. But China's weak, Europe's weak, the U.S. is sort of muddling along. And that means that oil prices aren't going to go up as the Saudis would like, but they've been right so far. And so that's a new variable that I've had to incorporate into my thinking. And so just recently, past few days, just to demonstrate that I am realistic and I'm looking at the world as it is, not as I'd like it to be. I did raise my outlook for a recession risk from 15% to 25%. And unfortunately, there is a certain sense of deja vu all over again. We had two oil spikes back in the 1970s. So far, the first oil spike we had last year hasn't caused a recession and hasn't been anywhere near what we had back in the 70s. And I don't think this one's going to be a major oil spike either. I think we are going to find that the demand responds pretty quickly to these price hikes, and it slows down, and oil prices come back down, not dramatically, but at least they stop going up.
What's the break point in terms of when prices of oil really do create a serious headwind and increase the chance of recession?
Well, I think they're already starting to impact demand. It's clearly getting a tremendous amount of visibility in the press. And of course, the price of gasoline is the most visible price of them all. We all go driving around, filling up our tanks, and everybody's seeing that the price of oil, gasoline has gone up dramatically. So I think we're at the point where it doesn't cause a recession, but it causes some demand destruction for gasoline and for other energy products. And that being the case, that could bring the price back down. I don't think it's going to cause a recession, but I think, if we sustainably, if we see the price of oil stays sustainably at $100, $110 a barrel, and the price of gasoline $4.50 to $5 a gallon, I think that could certainly risk a much greater slowdown on the economy than I've been thinking.
It's certainly going to cause some pain. Ed Yardeni, thank you, of Yardeni Research.
She is Jane Foley of Rabobank. And the heritage of Rabobank is commodities into foreign exchange. And Jane Foley, I want to look out 3 years and 5 years to the climate change effect. Sugar to the moon, cocoa to the moon, a few other things, even cattle's popping up here as well. How is the Rabobank world going to change with climate change and what appear to be surging commodity prices?
It's going to be tough. Now, of course, in the short term, we don't necessarily have surging food prices because prices were high last year. There was lots of planting. But I think we can all agree that over the longer term, you have climate issues, you have issues that could create inflationary surprises in the form of food prices over the next few years. And also the supply side. I mean, look what's happened in the Panama Canal, shortages of water, restrictions on shipping that can go through, impacts to the supply chain. So we know that climate change can bring us inflationary shocks. We know that it can have a detrimental impact on growth. We know that it could potentially make interest rates higher. So the environment that suggests is not particularly
John,
pretty.
this is critical, and that all the focus in the financial media is how to make a speculative return on euro, yen, or whatever. And there's a whole other world out there of hedging commodity transactions.
Okay, so interesting question here, Jane, for you. Climate can lead to inflationary outcomes. Can the policy changes to address climate change also lead to inflationary outcomes? Is this lose-lose on that front?
I think this is a really, really interesting question because we have so many elections next year. So next year, I saw a statistic recently that said countries with a collective population of 4 billion, so that's over half the world's population, go to the polls next year. So we've got the US, we've got the EU, we've got India, we've got Russia, we've got Mexico and various other countries. Now, amongst those issues that people are going to be talking about is, of course, the impact of climate change, but also the green transition. And what we've been seeing is people, because of the cost of living, because of the energy crisis, because of the impact of inflation, are losing patience with the politician, that the push towards a green transition. And we're really seeing this in Europe. Support for, say, the Germany's Green Party really gone down. Support for the far right really gone up. And this is fairly uniform because people are saying we can't afford to lose our jobs because of the green transition, because in Germany, for instance, lots of jobs in the supply chain for car manufacturers will go. And people are saying, we can't afford to buy these electric cars. We cannot afford necessarily the green transition. And that's a real problem.
How do you price that into a foreign exchange call? I mean, not to be too base here, but there's really a question of who's doing the best job in counteracting some of the inflationary forces in this swirling brew of uncertainty of how you're going to deal with this. I mean, this is what we're dealing with the UAW in the US.
In some respects, I think the answer is quite easy because when you are really confused, when you don't know what's going on, people tend to buy the dollar. It is the safe haven. And I think for an awful lot of these political challenges, they're going to be felt on both sides of the Atlantic. But I think it's the euro that will feel the impact of these political crises a lot more relative to the dollar, because the dollar, of course, is the currency of the global payment system and people need dollars in times of crisis. And therefore, the dollar, in a way, gets protected even when its own fundamentals look a little bit questionable.
And we've seen this dollar strength, and it really has upended a lot of people who thought that the ECB would do way more and that the euro would gain against the dollar, possibly even being in a better situation next year than the U.S. How much do you think the dollar has to run here if you do see this uncertainty pushing people toward the world's currency, and you also see a stronger than expected outcome in the economy there?
Yeah, well, you have it. You have this much more resilience in the U.S. economy. You have Germany in recession. You have the ECB bringing down its growth forecasts for the Eurozone last week. And in fact, they still look optimistic compared with our forecast for next year. So you have all of these issues. You've got the EU elections in June. You're going to have to see concessions made towards the far right. And when I say the far right, there is a little bit of a difference here because many of these, what we would say far right in Europe, yes, they might be anti-immigration. Yes, they may be really nationalistic when it comes to cultural concerns, but actually they have often little left-wing tendencies in their fiscal policy. So then you get concerns about the debt outlook. You've got Italy and Spain's debt rising already through some of the parameters that the EU would prefer. Does that mean there's going to be a debt crisis? Well, no. But does it mean to say that people are going to start wondering about the debt and being concerned about that debt? Well, yes. So I think there's lots of economic factors really facing the Eurozone in the next, which are going to come to the fore in the next 12 months. And I think the euro is going to be in the back foot.
A great piece on the Italian budget coming up very soon in the Financial Times this morning. Worth a read if you can get hold of a paper or the online edition. Bramo, I think I've said it 1 million times already over the last 2 days since we've been here. Europe, what a tough spot for the Europeans on pretty much every single topic we're talking about right now, including this one.
And this, to me, is really going to be a question going forward of how you unify a place with all of these very idiosyncratic stories, including in Italy.
20 seconds. What's your Euro call then? Let's go from high-minded climate analysis out 3 years. Give me a Euro call out 6 months.
We need to revise it because our forecast for now was 106 and we're nearly there. So, I haven't got around to revising it yet.
News here. Under parity?
But I would say parity next year will be being talked about.
Jane, thank you.
There you go.
Jane Foley, back to parity.
That's tradable.
Jane Foley of Rabobank.
We follow on to other central bank discussions. Simon French, chief economist Panmure Gordon, has been just wonderful with his experience in the British government of framing out a governor of the Bank of England who said, well, we're not going to declare victory. And boy, has the news come down the pipeline since Bailey said that. What are the ramifications of higher interest rates in the United Kingdom?
Well, we think there's about 60% of the 515 basis points delivered by the Bank of England still to crystallise, principally for the household sector in the UK. And that lagged effect is an elongated lag from previous economic cycles, where the structure of the UK housing market, secured debt market, was very different. And that is why I think Andrew Bailey has a really difficult task on his hands later in the week, because all the indicators I'm seeing is with that long lead-in time and the majority of the impulse still to come, we're seeing quite a rapid slowdown in payroll wage inflation. We're seeing a slowdown in core inflation. With the 18-month, 2-year lag, whatever frame, we think it'll peak around Q4 2024 in terms of the tightening of financial conditions for households. He knows that. He sees the inflation picture coming down, and yet he's allowed markets to guide the policy expectations rather than lead them.
At Durham, you were steeped in the economic history of all this. How close is the United Kingdom Bailey analog to the United States Powell analog? How separate are those discussions? I
think they're really separate, actually. And I think the last time I was on the show, I talked about the biggest decoupling of the policy environment in Europe from the United States. But it's not just the pathway, it's also the management of market expectations here. We've had some speeches from the MPC, the Monetary Policy Committee, from the Chief Economist Hugh Pill in South Africa about 10 days ago, talking about a potential plateau, but the market basically didn't believe that and sees the likelihood of a 25 basis point of about 80% as I left my terminal earlier. That is not where the Bank of England wants to be if it's going to carve out a narrative based on the latest data points, which show quite a rapid sharpening of economic momentum and also price-setting behaviour in the UK.
I won't allow the point you're making to get lost. This is so important. I landed here over the weekend. I read the recent communication from the Bank of England. Then I looked at all the economists' expectations, and they were saying hike, and the Bank of England was basically saying we're not hiking, and I couldn't make sense of it. Are you saying that Threadneedle Street is a massive credibility problem at the moment, and basically the markets are in charge?
Yes, I am. I think they're getting the wrong sort of criticism. They're getting criticism for being too slow in terms of takeoff on the policy path, but actually they moved earlier than the Fed. They moved earlier than the ECB. Actually, it has been the communications through this cycle. Part of it's been quite cumbersome in terms of, getting into the wage bargaining negotiation, the profit margin negotiation with corporates, with the household sector. That's not the role, as I see it, of central banks. Central banks, if you see a dislocation between the way the market is pricing your optimal path for monetary policy for financial conditions, you intervene. And it can be quite close to a policy meeting, which is to Tom's question about the decoupling between the Bailey-led Bank of England and the Fed, the Powell-led Fed. They've been reactive, not proactive in terms of managing expectations for this meeting. And it's been a regular pattern, unfortunately, over the last 18 months.
So even though you don't think they should, do you think they will hike on Thursday?
It's difficult, isn't it? I'm very clear that my reading of the data, and look, I don't want to sit here and pretend that I have a better reading than the 9 members of the Monetary Policy Committee, but I do think that the market has allowed itself to get expectations of a rate hike that I think the Monetary Policy Committee probably look at the latest and the most timely indicator of core inflation and wages, which they set out to their August Monetary Policy Report with their key data points. Those have slowed in July. Those have slowed in August. That's the new data that's come into the marketplace. Taking account of that, there's only 6 weeks till the next policy meeting when they'll have a new set of economic forecasts. You can pause that one out. you can say we're aligning ourselves with the potential pause in the US and in the Eurozone and not be an outlier. You don't want to be a monetary policy outlier in the UK.
There is a question, though, about a reacceleration in inflation, especially on the heels of oil prices that have been climbing. We just got news from Canada that inflation came in at 4% year over year in August versus a 3.8% estimate. We have seen this again and again. What's to say that there isn't something underpinning those inflation figures that will reaccelerate, that does warrant what we heard from Jennifer McEwen, which was a 50 basis point rate hike at Thursday's meeting?
You speak to exactly why an extra 6 weeks is most valuable, because those oil price assumptions, we're seeing similar turbulence in soft commodity markets, a leading indicator of food price inflation. The Bank of England redoes its forecasts in the first week of November. In fact, it does it in late October. It will have at its disposal for the MPC the type of impulse that will come through from those higher prices in terms of headline inflation and the potential second order effects in terms of core price setting. Why would you not give yourself the optionality of an extra 6 weeks to appraise those leading indicators, but also model the impact of those core inputs?
If what you said earlier, though, is true, that this is a central bank that has lost credibility and lost the plot, then wouldn't you see a pound that just weakens dramatically if they were to do that, if they were to pause, even in the face of people saying you need to hike and you need to hike more aggressively?
My reading of the way people are trading sterling, it's not based on a spread of central bank policy rates. It's on a spread of credibility. If you do a credible pause, you enhance your credibility. I'd expect sterling to strengthen against its major pairs, against that backdrop. If you deliver a message that says, we understand how this economy is evolving, we're in front of the data, we're guiding the market, rather than being reactive to each bit of pricing that they're seeing.
We got a bunch of thugs asking questions of Jerome Powell here tomorrow. What question would you ask Jerome Powell?
Well, I'd be fascinated to see what the FOMC come out in terms of long-term R-star. I think for me that's the key data point in the summary of economic projections we get. Do they believe it's still in that 2.5% to 3.5% range, given all the way out to 2 years we're seeing potential Fed funds rate north of 5%? Have we reached a situation where actually the FOMC have got to throw in the towel in terms of long-term R-star and the repricing that would have across equity markets, fixed income markets? That's
would move the markets.
Do you think they're ready to do that?
Well, ask the question. You might be surprised by their propensity to give you an
Powell
answer.
just didn't seem want to go there in Jackson Hole.
Oh no!
In the speech,
it's the skill of the Bloomberg team to tease that out.
Mike McKee's better at this than I am. Williams will go there. The New York Fed president. What's the guidance you would take from a man like that on where this might be going?
Influence. So the degree with which a debate. You're right. Almost certainly, Jay Powell is far too good an operator to even get tempted into that debate. The degree to which other members of the FOMC can start to frame that debate and say, actually, part of, and we've seen financial conditions loosen quite appreciably in the US economy. Part of keeping those elevated actually is to have that debate in public, such that markets can understand what that pathway is for long-term R-star in the US economy. Because at the moment, the summary of economic projections do not tell you that story.
Liz Ann Saunders was brilliant on this yesterday, John. Looking at the Bloomberg Financial Conditions Index, it's screaming accommodation right now.
This speaks to a phrase that Lisa used, reacceleration, and I think we're talking about the UK at the time. In that conversation, in that part of this conversation, the prospect of reacceleration in the US, something that we've heard a few times from various guests, is that current disinflationary trend is transitory. Would you go that far?
Oh, the dangers of using that word. Look, there is no doubt. I mean, if we're talking in the context of the US economy, the oil price is more significant. Actually, domestically in the UK, the gas price is more significant, which hasn't taken place or hasn't moved up in the same way. Look, central banks have carved out in the last 6 to 9 months a focus on core inflation. And therefore, are we now going to sort of pivot back to focusing on headline inflation? And given the impulse seems to be through the oil and commodity markets, that's going to be the first order impact in pushing headline inflation. It feels like you're moving the target every single time the data doesn't conform to your narrative. We're talking about credibility. Talking about the credibility of central banks. You've got to be consistent through the cycle, not just to fit your narrative.
If I could put you in a press conference right now, it wouldn't be the Feds. It would be the next Bank of England decision in a couple of months' time. That decision, is it November? Mm-hmm. The November one with the news conference. That is going to be... What are those forecasts going to look like for inflation, do you think?
Well, in terms of this is why it's the opportunity to talk about how the relevance of gas, wholesale gas in the UK economy being the more relevant one. Actually, I suspect the expectations for inflation will actually be lower for 2024 than we saw last week from the ECB. Remember what spooked the markets in terms of a north of 3% inflation print in the Eurozone in 2024? We got it from the OECD today, 2.9% in the UK. I think the bank will back into that forecast, a sub 3% forecast for CPI, because of the relevance of gas, which on the 2-year curve is about 80% lower than it was in the summer of 2022 when UK macro became the front page story. We had Yellen talking about it, Larry Summers talking about it because of the mini budget. But it was not just the mini budget, it was the dislocation of gas prices and how impact that is on real incomes in the UK.
You're talking natural gas.
Natural gas,
See, in America, we would say petrol. I mean, petrol, we confuse that. We say
gasoline
gas.
and
I allow you to translate my ropey narrative, Tom.
I said, keep up with
We're in
Simon.
London.
I did the
I'm going to start singing Mary Poppins to you.
The liter of gas 2 hours ago, we were talking about where does it hurt in the United Kingdom, like where will it actually affect Bank of England. There it is, John, $7.57 per gallon, $2 per litre.
It's brutal. I also can't
Did I
believe
spell litre correctly there?
It's the 1 year anniversary of the mini budget, isn't it? It's on Saturday.
It is.
Simon, thank you. Always a pleasure. Always learn something. Simon French there of Panmure Gordon.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.